devices, I want you to turn them off. Because what I want to say about Tuesday's speaker, I don't want to be public. Is that clear? Basically, what you're learning here is that the technical material, how to value a company, how to look for a company that is sustainably a good company, competitive advantage and things like that, is one half of what you're going to do as good investors. But what I hope you're learning from listening to people who are phenomenal investors like today's speaker is that it is the issues of character and process that are as or more important than the issues of technical competence. And what Manish talked about that seems to me extraordinarily important is the process of learning to be a good investor. And one of the sad things about the fact you only see these guys once and then you take off is that if you looked at the difference between last year's talk by Manish and this year's talk by Manish, he did an incredible amount of learning. And this by an investor who, from his start point to 2007, was up 30% a year. The incident that happened last year is he started with his checklist, and somebody in the class said, what is the top sort of gating factor on your checklist? And he said, not too much leverage. And then another kid asked him, what would be your first choice for a stock to invest in? And he said, Wells Fargo, for that checklist. Now, you will notice by this year, Wells Fargo got to be a 2% position at most. That is a phenomenal example of actually looking carefully at your historical failures and learning from them. So the simple thing we talked about keeping track of your successes and failures may occupy a sentence in the first half of the course, but it is critical in life, and I'm sorry we can't reproduce his last year's thing for him, but hopefully you will learn from them. Now, today's investor essentially needs very little introduction. He has a record that I think it's fair to say, although Buffett's obscured his in the crisis, that up until the crisis was the equal to, or perhaps slightly better than, Warren Buffett's record when he started in 1980. He started in 1984. So over that period, a record that is roughly just as good or better, and is done with a very concentrated portfolio. And I think it'd be useful if Glenn just starts talking about sort of his background that got into that position and how he broadly thinks about investing before I hit him with your questions. Now, I want to say one last thing. I don't know how you feel about us depriving you of the spontaneity. But like the Buffett annual meeting, my sense is that these pre-digested questions have been terrific. That you've actually gotten much more out of the speakers than in prior years, and you ought to be, if not pleased by the process, at least pleased by your contribution to it. Okay, with that as introduction, Glenn, it's all yours. Thank you.
The only thing I'd like to ask Bruce is that, can you tell me what the structure of these classes would be? You change them from year to year, and you don't let me know. So I have a amount of preparation for this class, which I'm now scrapping.
No. I mean, what happened is
we're going to do it in a different class. It's going to be fun.
Well, you should do what you intended to do. What happened was we split the course into two courses. One is a technical course that I teach to like 266 people upstairs in the biggest room in the place. And the second is where they come down here and listen to people like you.
You assured me that I would be in the legend course.
You are in the legend.
Oh. I just wanted to be sure.
But we had to find a work assignment for the legend course beyond just putting your butt in a seat and listening. So we decided to have them generate questions in advance. That's the only thing.
So I'm going to be brief because I saw the list of questions, which is very long. So let me tell you about my background and my way of coming at the investment business. And please interrupt me if you want me to move on to something else or dwell on something or disagree with me. I was an English major in college. I took a half a year of math and got a D- and dropped it and never took math again. And never saw myself going into financial work. I was a school teacher after college, got a master's in English, and somebody suggested that I go to business school, and since I had nothing better to do, I went to business school here at Columbia, and all the smart people in the class wanted to be investment bankers and consultants. I didn't understand what investment bankers did. I had made the mistake of asking Ken Lipper at my Lehman interview what investment bankers did. That interview didn't go well. I realized that was a really bad mistake. The one thing I enjoyed was there was one section of finance, baby finance, where they had us do some ratios and analyze a company and then decide whether we wanted to own TWA or not. And I thought I got the right answer. It's not wrong. And I thought that's kind of fun, actually, investigating companies and deciding whether they'd be good investments. They did have one securities analysis class, but the guy who taught it was talking about new issues and what hot stock, was trading on Wall Street, and I didn't understand. It wasn't really a class; it was more of a discussion for people who already knew about stocks. So that wasn't very interesting. And so with really no background or anything like that, I started at J.P. Morgan, which is then called Morgan Guarantee, their trusted investments department, and I still remember the very first assignment they gave me on day one. They gave me an annual report of a company and said a money manager just got this stock in his portfolio and he doesn't know what to do with it. So would you take a look at it? It was in two businesses. It was in the PBX business, which was losing money and didn't look like it was very distinguished. And then it owned 300,000 acres of virgin redwood in California, which was one of the best businesses in the world because you just have people come in and cut down the trees and ship them to Japan. You made about 100% profit margin on it. And the appetite for redwood in Japan is huge, and the yen was very strong, so it was very cheap. And so I just called some people to find out how much redwood land was worth, and it turned out that the redwood land was worth more than 3 times the value of the business. And so that was a really complicated analysis. That was my first one. I think probably shaped my thinking was that out there's some really simple things that you don't have to be a great genius to figure out. And probably fewer of them because every year there's 100 of you marching, hundreds of you marching out into the world wanting to go into finance and investing. And so it's more competitive than it used to be. But still, the basic idea is to try to find something which is a slam dunk like that, which you can put a lot of money into when you find them off of it. What did I know? It was the very first time I'd ever looked at anything, and it was pretty blindingly obvious to someone who was an English major that this was way, way over. I think probably I've been doing the same thing ever since, except to change the model a little. Today, I should carry the chronology through. So I worked at Morgan Guarantee for 5 years and decided that I was good at doing money mismanagement, which is what huge institutions did, but I wanted to learn how to be a money manager. And basically what happened there is you did research, and then you became a money manager where you did no more research. And I thought that's not the way to make money. The way to do it is be the guy who studies the company and asks the questions, and then also the guy who makes the decision what to buy and sell. So you have the most information. And so I went with a small firm that had a very good mentor, very good investment record, called Central National Corporation. And I worked under a drill master. And for 5 years, all I did was research. All you did is give me companies to analyze, and I would analyze them and do a 2 or 3 page report. Remember, there were no PCs in those days. There weren't even computers on our desks. So we did it by hand, and our secretaries typed out the little memos, and we did a 3 or 4 page memo with key numbers and tables, and also words in between those key numbers to explain, why we were putting the numbers down there and sort of a conclusion. And I did that for 5 years. Nobody in the office was allowed to buy a stock except for him. He was a genius. He was a phenomenal investment. It wasn't fun to work for. And after 5 years, so that made 10 years in the business, I then started cheap. So I say that by way of saying to you that nowadays everything's accelerated in life, and a lot of you probably aspire to be managing $1 billion in 2 years after you get out of here. And I would just say, word of caution, it's better not to be at the tip of the spear too early on. It's better to get some experience and let somebody else go through the 2008 type periods and the really crisis periods before you put yourself in that position. Don't be too eager. Don't be dissatisfied with being a research analyst, studying companies, getting to learn real companies. Don't be too quick to feel like you got to do it yourself. Manage your own money. I know that goes against the trends today, but I think it's good to have experience. It's definitely good to find a mentor, somebody who's good at what they do, where you can learn under them by just watching them and by reporting to them. So anyway, the place I worked, though, was he had a philosophy of investing in only a handful of stocks, which made sense to me, and also very careful research. In fact, his methodology was that he'd have you study a company. When you were ready, he'd have you come into his office without any notes, and he'd sit you down and he'd begin asking questions. And he'd keep asking questions until you got one wrong. And literally the questions would get down to what was the depreciation in last year's second quarter. And his point was he wanted everybody there to have all the numbers in their head so that they could think about the business all the time, even when they're taking a shower. But in being totally absorbed in the numbers, you understand the business, you understand the issues, you understand the questions and opportunities better than if you're just looking at spreadsheets that somebody else prepared, or if you've got it all on a piece of paper, but it's not in your brain. I really believe strongly if you're going to be an investor that you've got to learn to do the numbers yourself and absorb them and be able to think about them. Certainly know how many shares are outstanding, so you know how many partners you have in the business. He got very furious when he finally found he couldn't answer something, so it really focused him. So I started Chieftain. Basically, it was to manage my family's money and a few outside clients. We had $40 million to start, and we never marketed. And it grew to $1.5 billion, which is probably too much. Some internal, mostly internal, and some we took on. People heard about us, and I think people we took on Yale, Dartmouth, and Wesleyan, and alma maters. We really didn't market. And the view there was to spend as little time talking to Wall Street as possible, so we told the salespeople never to call, unless they had a block of stock to buy or sell. And we spent no time marketing, and we spent no time talking to clients. We always told the clients that there were only a few of us in the office, and if we spent our time talking with them, it would be not productive in terms of researching the companies that we wanted to buy for them. So we said, if you need a lot of hand-holding, then we're not the right people. So the point there is that when you have your own business someday, if you do, or when you're trying to structure your time, you might think at the outset about having the maximum amount of time to do your work and the minimum amount of time to be distracted by administrative issues or other things that are really a waste of time. And I consider marketing an enormous waste of time. But I understand there's the necessity for money on demand, but it really is. It's not productive. So Chieftain existed for 26 years, and we did have a record. Really, 08 wasn't very good. I think we beat the market by 8 percentage points on average over that time. the last 2 or 3 years weren't pretty. And I think maybe where I should also go in this is, now I have a new company, and I've learned a lot of things that I had forgotten over 26 years. Number one, I learned that when I don't read 10Ks and study the numbers myself, I don't really have the tools to make good investment decisions. And I didn't really realize that because the young guys that came on board all were computer literate and started building models. Wow, this is pretty cool when people can project out and put in more variables. So it became a very model-driven place. It used to be a yellow pad and studying the 10K and putting down the key numbers, and looking at the historicals, asking questions of management, and getting a good sense of where business might be heading in the next couple of years, and trying to decide, is this a good business? Is this a business I want to own if we go through another 1987 or 2008, or is this something that completely the wheels could fall? So you first decide, yeah, this is a business I think is a good business. Then you decide, is it cheap? And what's the outlook? And, to put a finer point on it. But I've rediscovered that without reading the material, the source material, you really don't have the information. Another thing I found, because we've now brought on 2 younger people to work with us, Jeff Jacob, who's here today, is one, is that they come in and they use Capital IQ, which I'm sure some of you are familiar with. And I've now, after a few months of working with them, decided that we should ban Capital IQ. Because it's so riddled with errors that whatever time you think you're saving is really, the numbers are not useful. They're wrong. And if they're wrong, you're going to be totally misguided. It's like being a swimmer and not knowing where the end of the swimming pool is and trying to do a flip turn. I mean, you're not going to get anywhere doing that. So I really would urge you to lay off the numbers that are prepared by others and just take the extra few hours. At first it'll be slower and more cumbersome to do the historicals yourself and scrub the numbers, but eventually you'll get super quick at it. Okay? And it will also teach you what numbers you really need to focus on. Because what I have memos that have 761 lines, I don't know what you call them, lines of stuff. There's masses of numbers. Anybody looking at it can't even focus on anything because there's so many numbers. Whereas you really, any company that you're looking at, you really want to boil it down to, a much smaller number. There can be certain major issues in any company you look at, and those could be the things that. I'll give you an example. Maybe examples are better than just rambling. We own Google. You say, well, how? There's so much you don't know. Correct. So much nobody knows. But one thing I do know is that, according to the international person, people spend now 30% of their time on the internet, as opposed to 10 or 15 years ago when they would have spent their leisure time, watching TV or something. But 30% of the time there, and 10% of all advertising is done. I think I'm willing to make the bet that over the next 5 to 10 years, the amount of advertising is going to catch up with the amount of time people are spending on this. I don't know what shape it's going to be in, and I don't know whether Facebook will find a way to do it better, but I'm convinced that Google, with 50% market share of internet advertising, will get its fair share of that growth. And that there's a lot of optionality in all the things they poured money into that aren't on anybody's radar screen today. But they put a lot of money into an awful lot of projects. Obviously, the nature of the business is staggeringly generative cash. And another, you could sort of say, well, now I can do a little model of Google, and obviously, you were just playing with yourself. In a sense, it's really a bet that if people are spending 30% of their time on the internet, that advertisers are going to try to find a way to get in front of those people when they're on the internet. You could model lots of different things, and there's a lot of numbers, and I know a lot of the numbers, but in the end, making an investment is kind of making a bet. It might be making a bet that redwood land is not losing its value, and by buying redwood land at 33 cents on the liquidation dollar, I have a very good probability of making money, even if these guys continue to invest in the PBX business. There's always a lot of things that can happen. You're always making a bet. And being a good investor, I think, is about, I don't know how many of you saw the movie Beautiful Mind, where John Nash, they sort of show it through his eyes what happens when he looks at numbers, when he looks at formulae. it's like certain parts of the formula get really bright in his mind. It's sort of like being able to go through all those numbers that are in front of you and just pick out the ones that really say something or are very meaningful. And those of you that have a knack for the business, and those of you who really want to, be in the investment business, not trading, are going to have to learn to really think about what's key in driving this investment. One of the ways that I, think about it, what I tell the young guys is when we're going to talk to a manager, start by saying to yourself, if there were 3 questions I could ask that, and I could give truth serum to the CEO or whoever, what 3 questions would I like to ask to get answers to that would tell me whether I should make this investment? And I'm not talking about, are your earnings going to be $4 this year? But just sort of strategically, 4 strategic questions that you might reasonably get an answer to. And don't get lost in your list of 35 questions that you pulled out, and they're in no particular order, and then you sort of work your way through a list. Is go for the questions that are going to really make your mind up pretty quickly whether this is something you want to explore further or whether it's something you just forget about.
Can you give examples of those questions?
Okay, yeah, I can give an example. I'm very interested in Abbott. So I'll just use real stuff. I'm very interested in Abbott. Abbott trades at 52. This year, its free cash flow will be about $5.20. So it's trading at, I've got to show a little value orientation. It's trading at 10 times free cash flow. It's a hell of a company. It's had a great record. It has very astute management that's made brilliant acquisitions. It's not overspent on R&D. Its orientation is towards chronic ailments, which would be a long, long runway of treatment. The problem is it's got one, which is treatment for rheumatoid arthritis, psoriasis, called Humira. It's now around 45% of earnings and growing faster than the company, and will eventually come off patent. Very complicated. There's only one example of this kind of a large molecule drug that's being made generically, because these are biologics. So it's a real question. It's not going to be a patent cliff that looks like all other patent cliffs. It's going to be something that looks more gradual. But it's still, eventually, all things come to an end, and this is going to face that. And, of course, it's in the drug group, so it's under threat. So if I were going to meet with CEO, the question I would ask is how he thinks about the maturation, how he thinks about a company that's got 45% of its earnings from one drug, will probably have 55+% of its earnings from that drug when it has its first competitor come off patent, and then when it comes off patent. How he's thinking about it, what steps he's taking to prepare. Because that's really the key investment issue. And that's where I'd start. And obviously he's given it a lot of thought, and his answer might not satisfy me. And I would challenge his answer, whatever his answer was. If he said, well, because it's a large molecule, because it's such a large investment, even though it's a very big drug and very attractive, I don't think there's going to be a lot of generic competition. I think we only have one competitor, and blah, blah, blah. And I would press him on that. I would press him on, what about the Pfizer drug? They're testing a small molecule drug, which would be a pill, which would be pretty devastating if that worked as well. So I would ask him that question, and then I would come at him hard to see if his answer, he had conviction in his answer, and whether his answer made sense. Maybe he's thought of some things in terms of positioning the company that I hadn't thought of. But clearly, it's the major investment issue when you're looking at a company. What's going to happen to this 45% of the profits issue without 4 or 5 years? So that would be my example. Another example, let's say, Ryanair, which we have a big position in. Ryanair is a low-cost European carrier, which was designed from scratch to be so much more low-cost than all flag carriers that it would be able to grow and take market share forever. And so it started about 20 years ago with one plane, and today it flies the most passengers in Europe. It flies 73 million passengers. It's got as much cash as debt, so it's essentially debt-free. It's returns on capital, it returns on everything. It's fantastic. You wouldn't know it was an airline. If you look at the financials, you didn't know the name. but they've been adding capacity very rapidly. The way it works is you make an order from Boeing. They did it after 2001 when planes were really cheap. They got a big order. Well, the order lasted all through this last decade. And of course, they had a lot of planes coming on in 2008 and 9, which were a terrible market for bringing on new capacity. So their yields, revenue per passenger, fell, and their earnings were pretty crummy. And so everybody got very doubtful about it. And the big question is they're running out of orders at the end of 2012. There will be no more. They have no more planes coming from Boeing. And there are talks to get another order going with them just collapse. So basically what happens in 2012, if they don't reheat these talks, is that they will then go into a very different mode. Instead of being growing 15 to 20% a year in capacity, they'll essentially have no new capacity. So that is a very interesting situation. Number one question would be, do you guys want to stop growing, or do you want to make another order? And if you could make another order with Boeing, what rate of growth do you want to? Are you going to go for? Because clearly you hurt yourself by going for 15%, and maybe you can handle it. But the yields get tanked. When the yields get tanked, you don't earn as much money. If you were bringing on less capacity, you wouldn't grow as fast, but you would also have better yields and therefore probably better cash flow. So I'd be listening for what's the philosophy. And what I'd be hoping to hear from Michael was that we don't want to grow as fast as we've grown in the past. We still think there's a lot of room for us to grow our share because of our cost advantage and all the new markets opening up in Eastern Europe, but we would see it being more 8% or 7% instead of 15%. That would be the answer I wanted. If he said, no, we think we can grow 15% a year, that would not be, I think, the best for the share. So it's trying to identify, the major issue. We were just doing an analysis. We said, well, just to tweak him a little bit, we said, what if they never added another plane? Their fleet today is 2.5 years old, maybe it's 3 years old. So they have a very young fleet. Most of the planes, flying American Airlines are 25 years old. So in a sense, they could run their fleet for the next 20 years without buying another plane, still be in business, right? And they could cherry pick routes. They'd be adding no new capacity to the market. They could just deploy their planes in the best routes, not in the brand new routes where they're trying to go to Eastern Europe and get a route going between one city and Germany. And you lose money for 2 or 3 years while you're doing that, and eventually it becomes a monopoly. You would just deploy your planes to the best of place. So we're trying to do sort of a blow-down analysis. Say, let's suppose you run this thing for the next 20 years, you never order another plane, and you just pay out your cash flow. And the only thing that changes is your maintenance CapEx will go up because the planes get older, they need more maintenance, and they need engine overhauls and so forth. So you have to kind of get numbers on that. And then sort of look back and say, today's stock price is discounting what rate of return. They did nothing except maximize cash flow. And I'm just coming up with the answer. My answer off the back of the match book is that making very reasonable assumptions, not kind of saying that they get great yields, that it would be about a 13 or 13.5% rate of return for doing nothing but just letting the thing run around. And if that's kind of close to the truth, then what I would say to him is, Michael, have you done this analysis? And if you have done this analysis, if you haven't, I'll tell you what it is, but if you have, how do you think about ordering new planes in the context that this is the bogey? It's a high bogey. If you're going to add new planes, you damn well better be sure that if you're going to add value to your business from here, you need to be able to get at least this high rate of return or higher. So, I don't know. These are examples of sort of questions. So I've rambled here for a while. Let's see. You guys want to talk about? I wanted to. How many people here believe in the efficient market hypothesis? That's a no at this point?
I hope so.
And a yes.
No, in most of the big places, the answer
Harvard
is
is
no.
yes.
Harvard is a no. Harvard always has, but they don't know what they. Increasingly, Chicago is a no.
Well, I just sent you these. I sent you these charts on. I thought kind of interesting. Ryanair has 2 classes of stock that are identical. One is the stock that Europeans can buy, and one is the ADRs that we have heard. And they're absolutely identical. The chart I sent you shows that at certain times the ADRs are sold at a 30 or 40% discount, and at other times it's sold at a 30% premium. It's not a very easy chart to read, but The other chart I sent you was the Comcast K and Comcast A. The A is the voting stock, and on the other hand, the management owns 35% of the vote. That's 35% of the vote, so there's no way the vote is meaningful, and yet it trades at a 5 or 6% premium. You get the same dividends, they have the same liquidation rights, everything's exactly the same. And the third thing I sent you was this article on General Motors, where the stock exchange and the SEC and everybody said this is worthless, but the stock was running like crazy. So I was, basically wanted to just tell you that I don't know if the markets are so efficient. If they are. On the other hand, most managers, how do you explain the fact that most managers underperform the averages, even more than their fees, if the markets aren't efficient?
You want to know what we teach them?
Yeah.
Oh, that there are systematic irrationalities to managers that are common for people who are selling their products. One is everybody's always loved lotteries, even if they've always been good at investing. They get rich big stocks, which are crappy investments that are shares. The corollary of that is that the value stocks, which are ugly and people just don't want to bother with, get oversold because people oversell them flexibly. And those are the professional managers. And the third thing is that they're always sure which is which. And in the world, you can't be sure of anything. So they overpay for the good stocks and they underpay for it. That's our interest.
Now, because somebody sent me a list of a huge number of money managers. These were not hedge funds. This was about 6 or 7 years ago. These were mutual funds, private investment people like Chief, and it showed their investment record over, I think, 5 years and 10 years. And what I was struck by was that I should have thought the bell curve would look something like the market would be in the middle of the bell curve, or maybe people would be a little below it. Maybe the bell would be a little below because there's some fees involved. But what I actually found, the whole thing was shifted down below the market pretty substantially, which made me think that it is kind of hard to beat the market, because I knew most of the people on the list. And, they're earnest people. They work off the card. So I never knew quite how to answer that question. I mean, obviously, if I thought everything was efficient and priced, I'd be wasting my time.
Well, but wait a minute. I don't want to waste your time.
Okay.
I really should listen to you.
Pretty important.
But there's something here that you ought to recognize, which is that over all investors, if you add up their returns, they have to be.
Yeah, what I'm talking about, these are
So
professional
if
investors.
these professionals are underperforming, somebody else is underperforming.
Okay.
And then you want to ask yourself, what are the biases that particularly afflict the professionals? And I think that they have to pander to these irrationalities in their funds.
Okay. Well, that's a good answer. That's a good answer. All right. I'll remember that. Okay. Maybe, since I want to get to your questions, maybe spend a few minutes. I gave you Lockheed and Comcast, Time Warner as issues. We don't have to. Bruce just told me that you spent a lot of time talking about what's a good business. So I wasn't going to spend a lot of time on it. But would one of you just like to tell me what you've learned about what makes a good business? Like, what are the qualities that make a good business? I know I talk, so I've got you already. So I have to pick somebody.
Go ahead,
Give me one quality of a good business. Let me put it this way. Let's suppose you had to put all your money over your career that you were going to save in one stock, and you hold it until you retire, and that would be your retirement savings. That's what you would live on. What would be the qualities that you would look for in this extreme and hypothetical? What would be the qualities that you would look for? Yes, sir.
Competitive advantage, like a barrier to entry.
That's pretty obvious, right? That's so obvious. As few competitors as possible. What else? How about rapid growth?
In terms of the IRR, in terms of cost of growth.
Sorry?
If the growth is very expensive, like the marginal growth you have below the equity cost, it doesn't matter for you.
I didn't get the answer. You like rapid growth would be something you'd want,
Only if it's
or
a
not?
No, if growth creates value, he likes rapid growth.
Yeah.
If growth destroys value, he's not so enamored of rapid growth.
Thanks.
All right, but would you be doing your screening? Would you be looking for companies that are growing rapidly, or would you be looking for companies that weren't growing rapidly and making this investment?
If the guy is destroying value, growing rapidly, faster he grows, faster he destroys my value. So I would prefer a low growth company.
Let me ask you this question. In a rapidly growing field, are you more or less likely to have a lot of competitors?
Probably more.
But he said that you want to have a moat and have few competitors.
Actually, his answer was about the barriers to entry. So if I had a barriers to entry and high growth, it's very sweet.
Okay, that's very sweet. That's very sweet. Tell me which ones. Tell me which companies. Okay, so growth was better than not growth. Certainly don't want shrinkage. What other qualities would you like in the business for all your money? Just give me one. Think of one. Yes.
High returns on invested capital.
Sure. Does anybody need an explanation, or does anybody disagree with that? How about the theory that if it's got low returns on invested capital, then it can improve them a lot?
I mean, that's sort of depends how much the business costs.
Sorry?
Depends on the price of the business. I mean, I'd like to find a cheap business with high returns on invested capital.
I've heard this given as a rationale a lot of times. There's two companies in the industry. One has, let's say, much lower margins than the other, and people prefer the low margin one because they can raise the margins up to the high level. So why wouldn't that be true? That you don't want to buy a company that's got high returns because it's probably going to come down. You want to buy a company with low returns because they have the opportunity to do smart things and improve.
I mean, I think it depends on the company. If you've got one that's had a history of high returns on invested capital, I'd rather own that business than one that I'm hoping is going to turn around. It's not that easy to turn around a business.
And what other quality would you look for? Yes?
Like a company that can put capital to work, because if it has a lot of, if it has really high returns, but it can't put any capital to work, then it doesn't really do that much good.
No. You give it back. As long as they don't do something terrible. Yeah, it's really amazing to find a company that can actually reinvest its capital at high rates of return. That's one of my complaints about Google. Google has $80 a share of cash, and they're generating up 30 this year, and they don't have a clue. Eventually, the lockbox will blow. I guess. Yeah, having high, the ability to, that would be something you look for. You guys are really dreaming. Okay, go ahead. What other qualities?
Low leverage.
Low leverage. Why is that?
Because it makes the uncertainty that having my valuation, if it has a claim of leverage, will
I like that. I would go. Profit margins? Anybody have a preference about profit margins? Low. How about management? Usually somebody says, I want a good manager. What's your thinking on man? How important is the management? And how would you value it? Yes?
I think it's important to the extent that they're historically and going forward good allocators of your capital.
Yeah. But your investment's going to outlast any particular manager. Let me put it this way. Let me ask you this question. GE, good management or bad management?
Probably bad management.
And what would have been the answer to that question if I asked it 5 years ago?
I think the common perception would probably be good management, but maybe not necessarily true.
Asked it 10 years ago, in the era of Jack Welch, you would have said, most admired company, most amazing company. AIG, good management, bad management. I don't have an answer to this, okay? What is somebody? I'd like to hear some other thoughts. Is management important? Yes.
I'd like to find a company where you can have a management team that can be so bad they couldn't even screw up.
They get screwed up by taking this cash flow and diversifying into something absolutely abysmal, right?
Aside from that.
I think it's a tough question. Having lived with Comcast for 8 years, it really has reinforced for me. You definitely don't want to invest in people. No matter how good the situation looks, you don't want to invest in people who are in don't focus on returns on capital. Who have other agendas. So, but I think it's pretty hard to know. No management intentionally screws up. certainly it feels good to invest with people who are absolutely killers and ruthless in running the business. Maybe the answer is you want to find people who are ruthless in the way they run their business. In other words, that they're Jack Welch, plus or minus, he was really focused on his business. You may say the number-oriented focus was exaggerated, had its downsides in some ways. Maybe strategically they shouldn't have built up PE Finance the way they did. But he certainly had his attention focused on the business. And it certainly feels good to have managers who you just have a feeling that they are incredibly not emotional, they're incredibly reasonable about their problems, they'll discuss their problems with you, they're not trying to emotionally stuff. So that they're really focused on, some people just want to win. I mean, they're very competitive and want to win. Other people are not, have other agendas. So I completely believe in investing in good businesses. And one of the times that was driven home to me was in 1987 when the market fell. I think 18% in one day and 40% in 1 month. And I made a
23%.
23% in one day.
And it's 12.5% in 1 hour.
12.5% in 1 hour. So, I made up my mind at that point that could happen again, and I'm just going to own only businesses that, if that happened, I'm fine with. I'm fine with stock being down. I believe in the business. I believe in that I'll recover. The value hasn't been lost. Not get into short-term plays or buying some junk because you hear a story or something. Because eventually you will no doubt sell it right there. You'll take a huge loss because you'll have no confidence. So and that'll happen from time to time. 2008 certainly. Early 2009 or something happened. So, this is just my view. So, what I wanted you to look at was Lockheed Martin with respect to their pension issue. I don't know if you had time to do that, but did some of you have a chance to look at it, think about it? Yes, good. We can have a discussion since you may be the only one who did. So what earnings should we be looking at?
For the pension?
For Lockheed?
Earnings numbers.
Yeah, well, we can look at, I want to examine what earnings numbers should we look at? You want to frame the issue for the people who didn't really look at it?
I think it'd be more appropriate if you framed it.
That's more appropriate if one of you framed it.
Make them do it. Go ahead.
Yes.
So they just defined benefit plan, which is kind of like the old thing where they guarantee benefits for you after you retire, as opposed to defined contribution plan. Mm-hmm. And so they have all these really old engineers who they owe tons of money to, and on their balance sheet they show, based upon some actuarial assumptions, which may or may not be right, how well funded those benefit pension plans are. Mm-hmm. And so the earnings they have to look at is how well do those assets, or how well do those investments do over time, because that's going to be a huge cash flow problem for that company when all those people retire and they have to pay those benefits out.
Mm-hmm. And do you understand how the accounting works?
Yeah, so they look at
Go ahead.
So they look at the amount that they anticipate they own. So they have actuaries who go in and they say, if these people live this number of years and they have these health problems and everything, you're going to end up paying out this amount to the retirees. Right. And then they look at how much do you have if you want to meet those.
No, I understand that. Do you understand what is FASB pension accounting?
I'm not sure what you're looking
Well, that would be Financial Accounting Standards Board tells you based on whatever, however well-funded you are or not well-funded you are, how much you have to charge your earnings with. Right? And then you have something called, I don't think, it used to be called ERISA, but it's basically an organization that decides how much you have to actually put into the pension plan. Forget about the FASB expense that you charge your earnings with. How much money do you need to put into your plan because now your assets in the plan have fallen, you're underfunded. So there's the pension contribution which you have to make to the plan, which is the cash outlay. And then there's something called cost accounting in the case of Lockheed. Oh, good. Help me. Cost accounting.
Just follow me.
I thought you were sort of thinking, oh yeah, I know what cost accounting is. Cost accounting is another way of measuring pension expense, which the government reimburses the government reimburses Lockheed for all their pension contributions on all the programs where they're purchasing the equipment. So it's like, if you have to put money in the pension plan, we'll reimburse you. It's all reimbursed, nothing to worry about. But we don't reimburse you because FASB says this is what your charge should be this year, and we don't reimburse you because ERISA tells you how much money you have to actually put in the plan this year. We reimburse you based on this cost accounting standard. Now, in the long run, it all ends up to be the same amount of money. It's just a time issue. So what I wanted you to look at is that the company reports earnings several different ways. And the point of having to look at it is to try to figure out, since you're all value investors, which earnings you should be looking at. But you didn't look at it. So.
No, they probably did. So to start off with, if you look at the FASB earnings with this enormous overhang of pension liabilities, will that give you an accurate picture of Lockheed's earnings? Why? Why is Lockheed different? It's just been Passover, so why is this night different from every other? Why is Lockheed different from every other company?
Because they have that reimbursement, and there may be accounting differences between what the government pays them back for versus what their pension expense really is.
There's a timing difference. They'll recover everything they put in, unless the government breaks its promises in the contracts. But they'll recover it, but they're not going to recover it at the same rate that they are forced to. So I thought it was very interesting because it asks you as an investor to think about, actually the earnings are quite different. The earnings, it's $7.40 are the estimates for this year under GAAP, and $8.27 under adjusting for this, the difference between how much they're actually recovering from the government in that particular year versus how much FASB is telling them they have to post as an expense. And then, of course, there's the whole free cash flow issue, which is then the second part of the question I wanted you to look at was, if you're a person who's interested in free cash flows, then how do you think about the free cash flows of this business? Because they're having to put enormous amounts into their pension plan, like $1.5 billion into their pension plan. And as you pointed out correctly, if next year interest rates go up, that'll change the discount rate. Or if the stock market keeps going up and the bond market keeps going up, it could be that the $12 billion deficit that they developed last year will end up being $2 billion deficit, in which case, issue over. So as an investor, it was a very interesting exercise in looking at lots of different numbers and trying as a value investor to be able to sit through and figure out whether the stock is attractive or very attractive. But anyway.
No, but can I do the simple part of this?
Yeah.
In general, is the Lockheed pension liability larger or smaller than for a company without the government reimbursement? Much smaller.
That's
sorry.
Well, that's one of the paradoxes of it, is that every analyst knows that for the 80-odd% of their business, it's sold to the government. The government has promised to, make good on the pension. So it's not really their problem. And yet, when they had to make this enormous pension contribution last year, and another one this year, and another one next year, it had a very dampening effect on the stock price. First of all, it hit their earnings, their GAAP earnings. And second of all, it hit their free cash flow, because if you look at free cash flow, you're going to, they have 380 million shares to put $1.4 billion in, whatever that is, that's almost $4.50 a share of cash that you don't have on hand to buy stock or pay dividends. On the other hand, what happens if you play it out is that 3 years from now, the free cash flows go way above the reported earnings, reverses. So I thought it was an interesting one to look at. Because sometimes value's just sitting there looking right in the eye. If you were clear about this kind of stuff, you would be able to say, and if you're an investor, you'd be able to say, look, this is not their problem, this is not their liability, and if investors are going to ding the stock over this, then that's an opportunity, if you like. Yes?
Well, I wasn't sure about, when we were looking at this pension issue, did they also cover the service costs, like running the pension plan, or was it just the contribution?
All the contributions.
So the entire thing was like, was there an additional $1.5 billion?
Sorry?
So the whole thing was covered by
Everything's covered. whatever money they have to contribute to the pension plan over the life of these contracts is covered. So it really doesn't have to do with the service costs so much as it has to do with how much money is Lockheed going to have to contribute over time to their pension plan to meet the obligations within the pension plan. And the government has to reimburse. They're able to bill the government in the next 12 months. As soon as they make the contribution, they start billing the government over 12 months, and they recoup it. But they bill them under cost accounting standards, which doesn't necessarily match up with what ERISA tells them they have to fund. In other words, there's 3 different schedules.
So do you adjust your margins for the uptake in revenue that they can reimburse for the pension costs?
The amount that they're reimbursed each year gets sort of flows through, and the difference between the FASB and this cost accounting, we adjust the margin for that, because that's a non-cash. And that's how they report it also. They look at their margins before FASB.
I could be looking at this wrong, but I assume that when things run through the email statement, they had in prior years they billed the government, that was running through subsequent years through the revenue line.
They have the expense line. They have it on the expense.
I thought they said that they had it in revenue.
They have it both.
Yeah, that's why I was saying so. That if you have subsequent costs coming through the cost line, and then you have uptick in the revenue line, it kind of offsets each other.
Except the cost is a non-cash cost, right? Because it's the amount you put in the pension the prior year. Now you can bill the government for it, so you bill it as a cost. You've already paid the money. You put the money in year 1, and you get it back from the government in year 2. It's probably not worth spending lots of time on. The idea was to get you to look at how, something is really, it's somewhat complicated, but it's not all that complicated, how it can distort people's view of the company and give you opportunity. And the other one is probably way too complicated, which is Comcast and Time Warner. What I wanted you to look at there is the different strategies of the 2 companies and think about how you would compare them. If you got that assignment, which you might. Somebody might say, I'm interested in cable and the internet. Everybody's using the internet more and more, and cable's very attractive because they've got the fastest service, and telco's going to set Fios, which is only 15% of the country, so they have a really good service everywhere else. It's a great business. So do some work on these companies, and you find 2 companies in the same field. One of them is diversified into cable programming. One of them is straight cable company. One of them is run by an empire builder. One of them is run by a guy who's retiring in 3 years. One of them is committed timidly to returning cash flow to shareholders. The other one's said we're going to return it once we pay down our debt. We're going to return it all. So I wanted you to look at some different philosophies. I own the one that's run by the empire builder, but
It's a lot cheaper.
it's a lot cheaper. That's what they asked you. See, if you've done your homework, which I realize I asked you a lot, but what I would have asked you is like, which is cheaper? And you would have said, probably Comcast is a lot cheaper. If you're looking at free cash flow that it's likely to generate, it's a lot cheaper. It has a much better balance sheet. It's selling at the same enterprise value. Should the less leveraged companies sell at the same multiple? It's got better ratios in terms of its capital spending, its profit margins. It's better. So it's kind of an interesting thing to look at the various different qualities. I guess what I'm saying to you is, capital IQ won't help you make these kind of decisions. You can't say enough about doing your own homework and then, sort of thinking about it. There's a lot of qualitative judgment that goes into making investments.
So you want to?
Should we do their questions?
Yeah. Okay. So the first.
Don't give me too hard with me.
No. The first one is actually Tiago.
I'm sorry. I think you're a really nice fellow. Your nodding in agreement with me was very much appreciated.
Thank you. We generally value investors look at like ugly, obscure share stocks because you can sort of have an edge. You are on the right side of the trade. There's more chance. When you look at your portfolio, you have like very big companies. You have Google. You have 20, 30 analysts analyzing each company. What do you do to sort of like make sure that you are on the right side of the trade? How do you avoid the problem like overbuying the shares?
It is a problem. There are too many people in business. That's because of people like me coming out. First of all, we've all made so much money, it's very attractive to people like you. Second of all, we all come out and bare ourselves and tell all our secrets. Third, things that are, is like, you're like, yeah, so what else? What else is new? 10 or 15 years ago, those were trade secrets. Reg FD means companies every quarter have a conference call and spill their guts. And then they go to these conferences in between and spill their guts. And there's an awful lot of smart people, and a lot of them are employed by hedge funds where fees are huge, so they can afford to have one guy who follows, one little area and he's on top of everything. It's a very tough competitive thing. So, I think there's certainly an advantage to looking at companies that are off the radar screen and they're smaller. And just because they're off the screen and smaller doesn't mean that they're good businesses or well run. Or if you can find one there that has a long runway and or that's very depressed, great. If you're managing $40 million or $100 million, you might want to spend all your time, looking for companies that people haven't heard of. We evolved from 40 million, and grew to 5 billion. And it wasn't we took on a lot of money. It was really just compounding and so forth. So we naturally had to move up into, especially if you're very concentrated as we are, if you've got 10 holdings or 9 holdings, it means you've got a lot of money invested in a few things. And just because probably something's widely followed, it doesn't have the potential to, it's not obscure. On the other hand, we owned Freddie Mac from 1989 when it became public till 1998, and it went up 30 times. And it was just a hell of a business. You know what? It was followed by a lot of people, but it always traded with interest rates. With the joke we would always do is we'd put the Coke results against the Freddie Mac results, and we would ask people, so which company do you think is interest rate sensitive, and which one do you think is we ask all these questions. Which one do you think is the leading consumer products company? And nobody could tell. Literally, the results of Freddie Mac from 89 to 98, 99 were as good, as stable results as Coca-Cola. Sold at 5 times earnings, 6 times earnings, and Coke sold at 20 times. So, just because something's big and out there doesn't mean it's necessarily well understood. Like I see the questions on Google, and I probably know less about Google than anybody, but the questions are, is search in America, finished? Is it yesterday's thing? And search in America is just, it's just the tip of the iceberg, it seems to me, in terms of all the opportunities that they have to, and in terms of all the ways people can use search. The analysts can get really focused on one little thing, and they all start chattering about it. You have to remember also the investment decision. Often there's the analysts who are following the company, and then there's the people who are buying and selling the stock. And they're not always the same people. They're generally not the same people. So what the analysts are focusing on, may have a lot to do with what hedge funds are looking for. They want instant gratification. We've got to give them something where we've got an edge and where we know we can give them information that's going to make the stock run, quickly, because they're not going to want to sit around for 6 months or a year. So, but I agree with you. Finding something that's, one of the best stocks I've ever had was a first-rate company that was the leading insulin manufacturer in Europe, but it was trading on the Copenhagen Exchange and wasn't trading in America yet. And that was a time when people weren't investing internationally, and interest rates were high, and so nobody really cared. And it was just a first-rate company, but off the radar screen. So I think sometimes you can find first-rate companies that are just sort of being ignored. But I agree with you, but buying ugly companies really doesn't feel like it.
Yeah, but sorry, just to follow. But when I say ugly, it's not like ugly. It's that like no one is actually looking at.
Oh, thin file companies.
Yes, because when you talk about like Google, you have like probably everyone here read 10K or know about the company. Yeah, but like you have like 30 analysts, you have like a lot of people always looking at it. You have like a lot of hedge funds.
I think what he's asking, Glenn, is why do you think that's
yeah.
Somebody's selling that stock to you every time you buy it.
Yeah, I know. I read the research reports on Google. Well, usually the research on Google consists of somebody who's trying to track clicks this month, or trying to anticipate what the cost per click is going to be, for the first quarter. And that's what the research is. Okay, I don't really see what I would call research, which is, I haven't seen anybody, for example, write a report about all the projects that are not making money for Google and trying to figure out, what they might amount to in terms of value in 3 years. I don't see anything. I mean, I saw what you call research and analysts. I think a lot of it I wouldn't call research. A lot of it I think is just sort of like guys at the track following the horses, reporting on which horse came in on this race. Which one won the first race, which one won the second race. I don't really see research. I mean, research is trying to figure out where the world's going to be in 3 years. And I'm saying to you, I think if 30% of people's time is spent on the internet and mobility is becoming, there's 900 million cell phones in the world. That's not right. Billion cell phones in the world, and only 50 million of them are smartphones, phones that allow you to connect to the internet. What's going to happen in 5 years when half of them are? I mean, what's going to happen to the opportunities for Google to do search when almost everybody's got a smartphone? I mean, that's just one thing. What about Google Apps? What about the cloud and the opportunity for them to eventually move companies away from PCs and putting all their information on the clouds and not having to maintain servers? What about the opportunity on Android to have cell phones where the operating system costs nothing, right? As opposed to other people. It's very advantageous to have an operating system that costs nothing. And of course, if it's an operating system made by Google, that's going to be, Google's going to get the search business, so it's going to search very fast. So there's just so much that you could do that'd be really interesting to really dig into and try to figure out, which would sort of to try to look where the company's going to be in a few years, rather than looking and see what paid clicks are going to be this month. And that's where most of the research is. It's a way out investment for me. It was just to celebrate spring. I'll tell you what I was thinking about also. I look at our portfolio and I look at all the companies that we're looking at. We're looking at lots and lots of companies. And I think the problem is that in the United States, there's just very little growth. And I'm not joking. There may be a cyclical rebound, but unemployment's going to stay high, and our country, little by little, is losing its edge in many ways. And jobs are going to continue to be offshore. And I look and I see a lot of cheap stocks with no growth. No growth. I mean, 3%, 4%. You're sort of hoping for 3 or 4% growth. You'd be thrilled with that. And I'm thinking that investors, especially if there's a double-dip recession or if things run out of gas in the next year, who knows what will happen. But that one of the companies I'm convinced will continue to grow rapidly is Google. And it's worldwide. It's got all financial characteristics that I like. I think of them in a way also like Goldman Sachs. Like the one asset Goldman Sachs has is if you get an offer from Goldman Sachs to go work there, you're going to take it over any other place. It gets the very brightest people. I don't know whether no editorial comment on my part, but they have a culture and they have an aura that they will get the smartest people. And if I was a young engineer today, and I got a chance to go work for Yahoo or Microsoft or Google, and at Google, I got to work on 20% of the time on my own projects and be a part of Google and all the projects they're involved in. Why would they not go to work there? And I think they'll get the best talent. So there's a lot of things that go into the equation besides, what do the Wall Street analysts may not be thinking about it that way. And maybe I'm not thinking about it right, but I'm telling you that this is how I'm thinking about it. I'm thinking about the amount of time people spend on the internet and how little advertisers have been able to tap into those people. And I'm thinking about all the money that Google has spent to position themselves for products that aren't yet generating income. And I'm thinking about the culture they have in that organization where they have the money to buy up young, promising companies that start out of garages, and they do all the time. And it doesn't cost them much, but they protect their finance. And then they take these bright engineers, 10,000 of them, and say, we want you to work on whatever you want to work on, so we'll let you work 20% of your time on whatever you want to work on. And so they're trying to maintain a small culture, a garage culture, even in a huge organization. And I think they'll get the best and the brightest. I think they'll come for a lot. I think it'll grow. Not a good value answer.
Okay.
What's the next question?
John Corietti. Have I got that right? John, are you here? P-O-R-I-E-T-T-I?
Anybody by the name of John in here?
Well, I'm going to read this question again. A significant proportion of your portfolio is invested in the healthcare sector. Will the new healthcare bill significantly change your long-term approach to evaluating healthcare companies? Will return on invested capital continue to be a vital signal for a healthcare company's strength?
The strength, return on capital, yeah, will be always a high something.
I mean, basically, he's asking, what about your investments?
So I have two investments in healthcare. One, and what I like about both of them is their market position. LabCorp, which does laboratory testing, which, as they say, is 2% of healthcare expenditures and drive 80% of healthcare spending. And there's only two national health testing labs. There's Quest and Lab. And LabCorp is better of the two, has a better mix of business. It's located in the south, across from lower. It's got much higher profit margins. And hasn't gone off, shotguns off, and gone into all sorts of home testing and foreign labs. And Quest has stuck its toe on any number of projects where they try to go off and diversify. So they've stuck to their knitting. And what I like about it is that, the way it works, as you know, the third party pays for most of the healthcare expenditures. And the way it works is that United Health or Oxford or WellPoint contract with the big labs to get a very good price. And then they force everybody to go to those labs. So if you and I wanted to start up a lab, and it's not easy because we can get the equipment and we can get the drivers to drive around pick up the collections. We can try to talk to doctors and having a box and all that. But the fact is, clients would have trouble getting reimbursement for this. So there's a huge barrier. It's an impossible barrier. It's really a business you couldn't enter. I like it. It's a slow-growing business. It's absolutely necessary. The part that's growing fast is the genetic testing. It's sort of esoteric and genetic testing, and I'm a big believer that that part of the business will grow, continue to grow rapidly, and then basic, fluids, blood draws, that's, sort of bread and butter stuff. It's not exciting. What I believe is that it sells a little over 10, maybe it's a 9% cash flow yield. So my thinking would be, and I've owned this since 2002, so 9% free cash flow yield, if it grows 3 or 4%, 5%, which is probably less than the manager would like to think it will, that's going to give me a very satisfactory rate of return with very low risk. However, the real reason I own a big percentage is because I believe that in the next 3 to 5 years that there will be blood tests for cancer. We'll be able to detect cancer at a very early stage before it turns into a tumor. And when that happens, I believe that that'll be standard of care. You'll go get tested every year for lung cancer. And if you're smoking, very cancer, female and ownership. And I think that will be a huge windfall for them because they just get paid for doing the tests, and they get a very high profit margin for doing the tests. So they don't care who invents the test. They don't spend any money inventing tests. They just perform the test. But because they can perform them cheaply, they will get the bulk of this testing. And, for example, the way I would think about it is they do, I believe, 8 million pap smears a week. So, for example, there's an ovarian cancer. The first test will be ovarian cancer, which is just starting to come on the market now. And a lot of women know somebody who got ovarian cancer, and by the time it was discovered, they're crooked. So they will want to get this test. So I'm just imagining, suppose 4 million, half the women who get pap smears go for this test at $100 a pop, 70% margin. These are the real numbers. You can do the math out of it. You say, wow, 107 million shares. It changes the trajectory of things, and that's just one test. I believe there will be a whole slew of tests so that 5 years from now you will be able to get a test, a blood test that will tell you if you've got cancer very early stage. And it won't be a broad test that will tell you every kind of cancer. It will literally be one for lung cancer, one for ovarian cancer, one for prostate cancer. So that's so I sort of figure you make 13, 14% with very low downside because the company uses capital very well. It generates massive amounts of free cash. I don't think the business is going to change in any meaningful way. But as people come up with genetic testing and companion diagnostics and a lot of other stuff that other people have to spend money to develop, they all can be the beneficiaries of this.
And when you said you bought it in 2002, they were using a lot of their free cash flow to roll off the lab.
Yes, correct.
That was for
Yes.
business. Now it seems like the roll-off is over.
Mostly. Given how big they are, this year they're going to make some acquisitions, and those will be very accretive. But that's not really the story
You know,
anymore.
what I was gonna ask about is that it seems that I saw that Quest and Left were both using some of their free cash flow to go out and acquire tests that could be the next big thing.
Yeah.
And I just want to ask about what your opinion is on, you know, owning a company when management, you're now, I guess, when management, you're now owning a company where management may or may not have a competitive advantage in assessing that technology, using the capital and free cash flow in that direction.
Well, I can't speak for Quest because I haven't studied it carefully, but I see LabCorp did that with, they took a position in a colorectal cancer test called PreGen, and PreGen Plus, and couldn't work. So they lost $20 or $30 million, which is not a lot of money for them, but it's, you know, they did it. They also made an investment in the companies with their come up with a ovarian cancer test, and that first test didn't get approval from the FDA, so that was another whatever. They've just recently bought a company that does HIV testing, and their theory there is that they can actually, through their sales force, you know, take that to many more. They can expand the use of that, and they can also take out a lot of costs. I think that'll be one of those very creative. So it's been a mixed record. If they were doing it with hundreds of millions of dollars, I'd be concerned. When they're doing it with tens of millions of dollars, and you know, it could turn out to be something where they make 10 times or 100 times their money, 10 times or 20 times their money, and if they lose it, it's not, you know, doesn't change the game. I guess I'm okay with it. The other company that we own in the healthcare space has 60% market share worldwide, and has really one competitor, who has 25% market share. And the rest of it is spread among little companies that are probably, and that's Varian Medical, which makes radiation oncology, and which is speaking. 60% of all cancers are treated by radiation, and radiation is getting more and more accurate and less destructive of tissue, of healthy tissue. And so therefore it's getting increasing uses. For example, if it's not very targeted, you wouldn't want to necessarily use it on your lungs because there's an awful lot of tissue that you wouldn't want to destroy. But if you can target the beams to really just hit the tumor and not much of the surrounding tissue, then all of a sudden, instead of having yourself cut open and have a one part of the lung taken out, you can be treated, you know, in 5 sessions, lying on a table for a minute, and not have the cost, and not have the suffering, not have the chance of getting infection. So it's an area worldwide which is growing. Probably the treatment of cancer by radiation is growing 7%, and they have 60% market share. They're the leader. Whenever the competition comes out with something anywhere, as well as the competition is a Swedish company called Elekta, they come out with the next iteration. And I think that there will be more and more uses for radiation. There are negatives to the story, which is a lot of it's reimbursed by the government, and the reimbursements are very generous. And therefore, it's a great incentive to buy equipment, which you don't have to treat hundreds of patients to make a lot of money. And eventually, I think the reimbursements in this country are getting expensive and come down. On the other hand, half their earnings come from outside the United States, where they're selling to national health programs, and their margins outside the United States are only 5 percentage points lower. So I'm not worried. I'd be very worried if the margins outside the United States are half those in the United States. I'm not so worried. So again, it's got rapid growth, long runway, a lot of smokers in the world. And more kinds of cancer can be treated by radiation oncology as opposed to chemo or sort of debt-free balance sheet, really high returns on capital. So I don't have a view on the healthcare field, but I have a view on this one.
Okay. The next one is Yi Zhang.
Yes. I want to ask about the discounted cash flow model. Discounted cash flow model. I'm just wondering what hurdle rate you are using now, and how did you get it? And also, do you use the same hurdle rate for different companies in different sectors as well? And do you also use it for like the selling price, to decide the selling price as well?
Multi-part questions get me because I always forget. Let me just answer.
Basically, what she's asking is, how do you use DCF model?
Okay.
And in particular, how do you calculate an appropriate cost of capital using it?
Okay, thank you for asking that question. Okay, so I remind you when I started in the business, and up in every company I've ever analyzed, I I did on a yellow pad, okay, which wasn't exactly conducive to a discounted cash flow model. The young people who came into my firm all were computer literate and developed the discounted cash flow model, which became the model I'm using. The model was utterly useless in the last 3 years. Utterly useless. And so I'm now, in my new firm, going back to doing things the way I used to do things, which is basically have a very clear view on why I think it's a good business, and a business that can grow, my expectations for the business, the quality of the business, and a very clear view of where I think the business will be in the next few years. Okay? And I'd like to think, the way I would probably think about discounted cash flow is I would start out with the free cash flow yield today and think about what I think the business is capable of growing, say, over the next 5 years. And if that comes up to something like 15%, the combination of the free cash flow yield today plus the growth rate that I think is reasonable, then I think I've got a pretty good investment. And the reason I think that is because I think the market probably, over time, you tell me you pick a rate, 7%, 8%, 9%. If I've got something that I think is going to give me 14 or 15%, then it's clearly undervalued relative to the market that is priced to give me 7 or 8 or 9, pick a number. Okay, so I think that I'm very down on computers. I think they're a complete waste of time. I don't know how Warren Buffett feels about it, but you should ask him.
You did. And Warren Buffett feels exactly the same way, except instead of using a hurdle of 15%,
You use 13.
You use 13.
It all depends on where that was a time when the stocks were really high. I did answer that question because I used to basically, believe it or not, the business was easier, used to just sort of ask myself, could I see how the stock would be up at least 50% in the next 2 years? Like based on where I saw the earnings or how things would develop in the next 2 years, did I think reasonably the stock could advance at least 50%? And that was sort of the hurdle rate. And then over time, the markets got higher and more competitors in it. And I got to a point where if you were trying to think about what stocks could be 50% higher without making assuming the multiple went up a lot, it got impossible. So you had to sort of think, well, maybe 20%, maybe 15%. How low do I want to go? When the market was really high in 07 and interest rate, I think that's about 07, we were talking, you couldn't find anything to buy. Interest rates were really low. So put your money in the bank at 2%, or should you own a stock that maybe you thought you could make 8%? It kind of got to a point where you sort of asked yourself, how low will I go? And I asked Warren that, he said 13%, which was pretty close to where we were sort of thinking 15, but it was hard to find things at 15, so we weren't buying it. So that's my new way of thinking about things. Is much simpler. Free cash flow yield plus, a reasonable rate of growth. A business I have confidence in that I'm not going to wake up one day and find out that thing fell apart. And that I want to get the best group of those in my portfolio. This kind of cash flow model converts.
Okay, Grant Limke.
Yeah. You have a very unevenly distributed or weighted portfolio. Small to very large. So I'm curious how you judge that what you think is your risk reward on investment into a weighting in your portfolio.
How do we decide that something should be 12% and something should be 10%? Well, it isn't systematic. It's judgmental. And we've been doing the business now for a long time. It's always been an issue of how much money at any given time do I want to have in these different stocks that I know about. I mean, I wish I knew about the stocks that are going to double the next 12 months, and I put all my money in those. Or the one that's going to go up 1,000%, I put all my money in that. So you try to find the best opportunities that you can discover, and then you sort of figure out, your confidence level around them. And sometimes the one that you think could go up the most, you also feel has more risk factors. Let's take Ryanair as an example. I mean, is the airline business. If the price of oil spikes to 150, that's going to go. It's going to go right to the bottom. If we go into a double-dip recession, travel collapses. It's not going to be good for them. I mean, there's a lot of stuff they can't control. On the other hand, if the price of oil doesn't spike, and if there's a recovery in Europe, their earnings are going to go up a lot, and the stock price will do very, very well. I have to be selling at about my recollection, something like 6 or 7 times year after its earnings. So I mean, there's a lot of room for it to go up. But I wouldn't necessarily, there's a limit to how big a position I would take in something where there's also there's nothing I can see in Comcast or in LabCorp that could just blow you out of the water. But the price of oil, I left out the fact that it's denominated in euros, right? So if the euro collapses, that's going to depress the stock price in the U.S. dollar. So that's something I can't control, and that's a risk I take. So I can't give you a good answer, except that the smaller positions are the ones that either I see less upside or I see more risk. Usually means less upside. And then the larger positions are the ones where I feel the greater certitude, in sort of the nature of business and the valuation. There's no formula. I know other people do, like 5% positions in 20 things, or a 5% position is a big holding, and then a 2% position is the things they have less confidence in. We've had 20+% positions in certain things. And I'll tell you, that does wonders for your performance when you put it in the right things.
David, the reigning mind.
Since you founded Chieftain, what was the worst investment that you made? How have you learned from that experience?
If you lose all your money, that's the worst, right? We put 2%. We had a rule that we won't put less than 5% of our money in a stock. If you don't have the confidence to put 5% of your money in it, and we invest all our own money, 100%, in the same portfolio as our clients. So all the portfolios look the same. I mean, no money is solid. It's all there. We put 2% of our money in a stub of an LBO because we knew a director and we thought the deal was great. The business was the mattress business, and it became known as Flaming Mattress because I think they couldn't get the bridge loan, and now the whole thing fell apart. Interest rates were through the roof. It was in 1980 something, but interest rates were very high, and basically for financial reasons, in a recession, financial reasons just suffered. So this warrant that we had to buy stock, 2% of our portfolio. The second time I lost all my money was back in 1992. This may be instructive. 1992, the earnings on the S&P were $20, and the market was trading at 430, so it was 21 times. And my partner and I were really stressed out about the level of the market. And so we decided, since the market seemed so high, that we would buy puts on the S&P. So we put 2% of our money in that. And the market went up, so we bought another 1% puts. The market kept going up, and so we lost 3% of our clients' money. And of course, the market went to went from 400 to 1,600 in the course of that decade, and the earnings went from 20 to 80. So I guess what I learned from that is your insights, my insights in the market. In terms of actual investments in companies that were terrible, what did I learn? I think what you learn is you probably shouldn't go away from the things you know about. You shouldn't go too far afield into things you really know nothing about. And you guys you won't. The next class will laugh at me about Google and say that I violated that. You can lose money in things you know a lot about too. But I think it's mostly the lessons you already know. Is don't get in with a management that's got another agenda. And buy a business that's really solid. We lost a lot of money in a business called Crosstex Energy, which is a midstream company. And we really lost money not because the midstream gas business, transportation business, is a bad business, but because the management went out and made a couple of acquisitions that didn't pay off. And so they ended up having to just cut their distributions because they took on the debt and didn't do well with those acquisitions. So it was just, a lot of the other businesses in the industry did just fine for this period, but this one was just a bad choice. And they're good God-fearing people. Now, honestly, if you go on their website, you can say, boy, this seems like they have a good culture here. They just made mistakes.
Kevin Sales?
Yeah. Could you talk about Iron Mountain, how you found that deal and what you want to run it?
No, we're not in Iron Mountain. We haven't been for a number of years. This is, again, an interesting story. My associate, Tom Stern, found it. He was looking through this sort of summary of research from Bear Stearns, that listed all the companies they follow and basic data on them. And he found this company at a time when the market was quite high. He found this company that seemed to be selling at 6 times earnings. So he said, well, let me take a look at this. He never heard of it. And he looked at it. It wasn't 6 times earnings. It wasn't 6 times EBITDA. It was just a complete error. But we got interested in the business. And again, it was a kind of giant market share in pretty simple business, which is taking people's boxes, putting them in storage, destroying them, or sending them back if needed. And they had rolled up an entire industry. I think they were 10 times larger than the next competitor, so they can handle national storage of big accounts. And it seemed to us that it would be a very sticky business because they charge you money to move it to somebody else. So that it seemed like an incredibly sticky business. It also seemed to us that it's such a tiny cost item for hospitals and insurance companies and so forth that they should have the ability to raise prices pretty aggressively when they wanted to, and that people wouldn't move their boxes. And that part of the story, I mean, it never really panned out. They didn't have the pricing flexibility. And we eventually sold the stock. We did okay. A lot of the metrics of the business they turned out to spend more capital than they said they had to spend. They never were able to raise the prices, and it just eventually got tired of it. So it was a mistake. It was a typo from Bear Stearns that led us to the other.
All right. How do you feel in general about companies? Oh, I'm sorry. You're the guidance. Sorry. Go ahead, Yuri.
I mean, I was just wondering if you're still comfortable investing in companies with dual share structures after your experience.
That's a good question. Well, I don't know which ones exist anymore. You know,
but if you came
I would think about it. Now, you know, there are a lot of non-dual structure companies where the board and the management are very cozy and they run the thing badly and overpay the managers. It isn't. How many big companies can you name where, you know, agitating investors are actually able to make a change? The funny thing about Comcast is, quite honestly, we had such a big position and we were so upset with the way they were doing things that, I don't know if you know this, a couple of years ago, we became agitators and we did a study. We did a very careful survey of investors, got their views on why they thought the stock had not performed. A lot of it focused on management, attitude, management, stewardship of capital, all the right issues. And we prepared a really meaningful analysis and sat down with management, sent it to the board. And that's sort of where the gloves got dropped. But and they circled the wagons and all that stuff. But in the end, they ended up doing most of the things that we wanted them to do. They've really improved the way they work. And now every other word is free cash. I mean, literally, they didn't understand free cash. There's a term like, what does that mean? It was unbelievable. It was like the last company in America to figure it out. But they figured it out. So sometimes agitating, just will get people to the right spot. I would be. Just all the warning signs were there. And, so it's a good point. I agree with you. Best to avoid it.
All right, this will be the last question because it's also the most contentious. Chidia Bile, Iwa, Shoot, you hear? I love the people who write the questions and then don't show up.
This must be today.
So I'll read it. What lessons did you learn that you would like to pass on to us when you lost a quarter of your portfolio in 2006?
We lost a quarter of our portfolio in 2008.
That's right.
Yeah. What lessons? Okay, so I was here in this classroom just after we hit the bottom. Because in March, I was here in early April. I know this is going to sound bad to tell a student of yours that I think what the lessons I learned, number one, throw out the knives. Okay? They don't protect you, they don't do any good. It's not. Number two, never work with people who are on margin because it completely color their judgment in the period of last year. And instead of being able to buy when things are really cheap and the risks are high, they will be so scared, they will be so terrified. So I would say, learn, don't go on margin. Just don't do it. It's relearning the same lesson about doing your research carefully and buying good businesses because all the good businesses have come back. The stocks have come back. American Express is 41. And when it was 20, I remember some guy ran up to me and said, "You own American Express." With Mark Kingdon's annual meeting, they just said it's solvent and it's going to go to zero. So, and it went to 10 before it went to 41, but, it wasn't insolvent, and it didn't go out of business, and, it's a whole franchise. So I would say, it still pays to really, most of the time you don't need it, but for those really bad periods, you're going to really need to have quality companies that you understand, and you understand the recurring nature of their business, and to have stomach. And obviously, the times you make the most money is when things really look awful, and nobody has a rational answer to how we got out of the problem. We're going to get out of that problem next month. We get plenty of Muriel Rubini's running around telling you the housing market's going to get out another 50%, and everything was bankrupt. You would never get out of it. And stocks are overvalued at $670, and earnings would be $40. You have lots of those voices, and you always will. And what you really can come down to, if you know a company well, if you've had a history of owning it or studying it carefully, you'll see it at a price where you just say, General Dynamics at 6 times its current year earnings. It's just a crazy price. We owned it for many, many years. We couldn't buy it at 6 times earnings. We were scared.
Okay, the bottom line answer, which is the one he gave last year, is he thought very carefully about everything he did from a value perspective and decided not to change it. And how did that decision work out? Really well. So, thank you very much. I do remember. We've done Google Works, and I just didn't have
Omar sent you the and I'm like, that was great. No, listen, what am I going to say? It's terrific. What am I going to say if we don't? No, I'm just saying that you are speaking. So what makes that core conceal is not
It's that, it's a distribution. It's just they loaded it in distribution. And local density is what determines cost structure of distribution. They put much of the distance request about dominating local markets. Right, but they've all been locally focused. We're lab focused.
Actually, the really spectrum was right in the creek. Absolutely went to and they started up first. They recently sold it to an LBO shop. And that was a big scare in like in 2002. They got the spectrum.
How long ago was this? 2002.
So that is the answer.
You didn't have these deals which were like United big.
Right, no.
You didn't have that back then, so you could go in and work.
No, but the point is that if they could offer a cheaper service, United's listening, and they go to that point and they say, cut your rates. They can't because they don't have the economies of scale. Same with Ryanair. You know when Ryanair also got in trouble? And they opened a lot of other airlines. It's the way everyone in these airlines does. They start with one company, they dominate all of the economies of scale. No, but they did. I don't know if you noticed, but they did a crisis. They got rid of they've gone from one hub, to 23. And they're back down to, well, at least that's what they're more.
You mean hub? Where they fly from?
No. Yes, where they organize the route structure.
No, you see, they don't have it. They fly everything's point to point. They don't have anything. Zero.
It's not
what's great about it, pilots sleep at home every day.
You mean everything is point to point?
There's no flying to Cleveland and that's a hub and you change planes.
No, that's not what I mean. Let's talk about the old Southwest. It was the other really successful model. How did they start? Every flight started out and it was they were completely unmarketable. And they were separated from all the other markets. So once you were Southwest, you were hardest to. And they did exactly the same. They copied Southwest. And then they started route structures where they could be accounted one market. And just notice that they got rid of that.
They're growing the number of markets they serve.
I'll get the press releases.
No, but I follow it fairly closely. They enter new markets. When they enter a new market, it's a blitz and they usually go to 30%.
Well, the way Southwest did was first is they went to the airports. So what they do is, if they always enter the new market, they wind up planes in their old market. So they add routes that are back and out to Central. No, they did Dublin first and then they did States.
Yeah, they fly all over.
Right, and then they did a lot of other things out and back. And they cut back and then go back and back.
Somebody's giving you that.
Oh, really?
We were even in Italy 4 years ago. Wherever they see weakness. Facts.
No, I keep working. Because the one we know that did that and lost the discipline is out and back root structures.
Maybe you started with that. Actually moving.
All right, we'll see. I don't think
it's totally gone the down.
I don't think that's good.
Hi, Bruce. Thanks for having me. Thank you. Take care. Jeff, I'm going uptown. I'm going to help you.
Yeah, no, I'm going to help you.
I'm going to my house. Hi, guys. Yeah. Oh, no, I think, yeah, we'll.
Let's, we're on. How are you? I didn't have any. You noticed that we had a discussion in the aisles for your father. Normally we try. I'm sorry you had to sweat through the show.
You keep your classes warm.
No, it's not that they're warm. So there were too many.
My class very cold.
We would love to, but if we can't keep the body. Anyway, it's an honor. See you back.
We need your badge. Don't forget.
The reason is that is always but there's an enormous amount of information. Don't forget those searches. The crucial thing is the searches. That's where they make money. And that's why Microsoft went into what they do is that they have now algorithms that are home for individual users in the order in which they put them. And the way they do it is to maximize not only the click-through things that they put down, but to maximize the conversion rate of those click-throughs. So they are the most efficient place to put your advertising.
I don't doubt that. Yeah, search isn't perfect for me. If there was a technology
I'm not disputing it. Increasingly what they're doing is customizing. So, depending on what you're looking for. Now, unless out there is some quantum improvement, not just they are going to beat everybody else hollow in the business doing better with the existing technology. And PageRank is distant history. It's not. It's much more complicated. And they have all this information that enables them to target the ads, but also to target the display to the
but still very beyond it. If I want to search for background, where's the friend for the high school, you get 8 different results that doesn't tell you the answer.
Right.
So there's still obviously room for improvement.
Right. But who's likely to do that improvement?
Yeah, I mean, hopefully that's eventually.
So you have it. So I think what you have to do with Google, I mean, you notice how he basically does, because he does great businesses. He does an implied trade. Now he just does it to destroy. He does one growth rate and a current cash flow yield. He doesn't try and disaggregate the growth rate into growth that comes from the investment, active reinvestment funds, and growth that's organic because it's growth. But it's exactly the same thing as we're doing here. If you've got 15% and the market returns are C of M are 8. Say you've got say there's a 4% chance every year that somebody wipes through that. And you're left with almost nothing. It's covered by your margin safety. And the longer Google goes, what do you think happens to the probability?
Well, yeah, I mean, you think that they hopefully became aware of that and just buy it up even if they did see something.
Well, that's the first thing. So because the advertisers are sticking in, and they do, for the advertisers, they'll give them an ad budget, and they will optimize the placement of the ad budget.
So how has Microsoft been able to gain share with their big travel?
Oh, because what they've done is exactly what you have to do in a situation, which is that for travel searches, Google is now optimized. So for travel services, which is a very narrow segment, Microsoft concentrated all of the resources. And
it's not a bad strategy.
How did Baidu kill them in China? Because it concentrated all its resources on ideographic Chinese search. And it does a better job than Google on that. Now, that is the strategy you should absolutely learn to do in strategic behavior. Right?
You don't think it's transparent? You don't think they can, as a user, as a consumer, if I start going to bid and travel for my airline tickets,
because again, business models work pretty good. Now, if they're sensible enough to do a Walmart strategy, and Google tries to do every place, and they do in adjacent segments, then like restaurants, things like that, then it's going to make it big. Then they have a chance. But hopefully, Google understands those geographic strategies.
But they've never really gone into the vertical search space. You don't seem to go into medical searches.
You mean Google?
Yeah.
No. So now you know how, if you want to look at Google, to do it either as a language that they haven't completely covered, or you've got to do it as a vertical, where you are just the best search engine for a certain subset of information. Right? But I don't think I don't think the probability is high enough for
You were saying about Yahoo search back in the
No, I wouldn't. That's the key. When you see rapid displacement of one search engine by another, so, first it's Archie, then it's Alta Vista, then it's Income, and they displace the others in about 18 months or 2 years. You have no confidence for the first 2 years as Google is it. So anybody who invests in Google at that point is asking for trouble. But by the time Google goes public, actually, they've been dominant for almost 4 years. And by now, they've been dominant, basically in 2000. So they've been dominant for 10 years. And once that happens,
yeah, I agree. It's a huge likelihood of displacement.
It's the likelihood of displacing them goes way down.
But you also know with Apple on the iPhone, if they can disseminate the iPhone, and now you've got the platform in your hands, and that's the technology now you're using to do local search and whatnot.
Who owned the technology that Google basically built themselves to do?
Yeah.
They own the operating system. It's like owning the handheld thing. They're the people who control the PC. Windows is it. Did that stop Google? Did that stop Oracle and database management? Did that stop Adobe in France?
But 10 years ago, you would have said, or 15 years ago, people would have said, Microsoft Windows operating system has a dollar margin. Nobody can crack it in this space. For those very same reasons.
Right. And guess what's happening? Who's cracking the operating system?
All the operating systems.
What market should we use? How do you think Apple finally resurrected its computer division? No. The iPod was developed actually a long time before Apple turned around. Apple turned around, I think, 2007. Could have been 2006. When did the iPod? When did the iPod? No. When did the iPod come out? 2002. And the iPod got better and better and better. And the computer division went continuously down the tubes. You know at what point?
But then you had an iTunes that you put on your...
No, that what happened with iPod. The iPod was always associated with iTunes because that was the whole point. Okay, so all that started.
I just think that made consumers a little bit more willing to switch.
So why then for the first, and of course iTunes downloads work with Windows. So why during the first 4 years of the iPod Does the iPad take off and Apple's share continues to decline in PCs? It's so far.
I became a Mac user in 2006.
And why?
2004.
Okay, you were early. Why did most people become Mac users? What was the big change with the needs? And it was the low.
It's the ability to both.
Yes.
Microsoft software.
No, first they did Intel chips.
No, that came after.
No, Intel chips and Microsoft supporting Windows happened at the same time. It happened, and finally made the announcement, I think it was as of the middle of 2006, because somebody was making your argument in class. And I said, okay, and Apple, I think, was trading at $75 a share. And I think so. Maybe it was 90. And we had a bet, which is, I know it was 90, yeah, we started the argument when it was 90, we got there at 75. And I said, okay, if at the end of the year, it's below 75, you'll pay me. And if it's above 75, I'll pay you. We had a short on it. Apple went down to like $48 a share. And guess what they did that day?
So this is 2006. So let's say they announced the Intel.
Then they announced Intel at the absolute low. And we covered the short immediately. And the guy won the bet because, of course, I couldn't call out the bet at that point because Apple finished the semester and got like $82 a share.
We now have some very, very smart investors including investing in Apple at $200 billion market cap. Top five.
Does Bill Nygren make mistakes before?
Yeah.
What's Bill Nygren counting on? What's got to be true? Right. But in a sense, what does it take for the iPhone to go profitably in the markets? It has to gain dominant share. It has to be able to protect that dominant share.
I mean, it's like the iPod where it shot up without having that dominant share.
No, it didn't shoot up. First of all, they have hitherto, they're starting to make money on the iPhone now. But in the beginning, they didn't make that much money on the iPhone. But think about it. Is everybody copying the iPhone now? Pretty much, yes. And there are other operating systems, like the Google operating system, that all the iPhone apps are going to work on it on because it's an open system, and we might as well adapt into that. So once that happens, and you can download Chromium for free, what's the iPhone's advantage?
Just this design that people have to be attracted to it.
The design is exactly the same.
That's not an advantage, it's just a preference.
Well, it's got to be a preference for a brand. And you're going to pay $500 for a brand when somebody else is giving away, some system operator is giving away an iPhone clone for free. I think there's that much customer activity among non-affiliated customers.
But so if you look at it as a short, you have to start, I wouldn't put short on it before I start seeing a transition of those.
Yeah, no, you have plenty of time to put the short on. But I think he's nuts to have a long on this. I mean, I think, look, does the iPhone fundamentally have a competitor? Doesn't have scale. Because it's the systems operators who determine whether to support them and whether to sell them. Doesn't have that much customer activity. And sure as shit doesn't have
Yeah, I mean, you make a lot of the same arguments about something like Amazon.
it still hasn't gotten there. You're right. No,
we managed.
No. We have been consistently wrong about Amazon's stock price. Have we been wrong about Amazon's earnings? If Amazon's earnings don't grow, you think that stock price is going to continue to stay up there?
I don't know what's going on with the
Rate
emerging markets or
commensurate with
European
that?
markets. I don't know if they can move into that space.
Why? I doubt it. I mean, think about it. They're only have local language sellers. All the guys like Sony is going to have its own website. So you'll have a choice. You can buy from Sony at outlet, or you can buy a Sony through Amazon and pay another 8 to 10%.
I was thinking about that the other day, but what are the incentives for manufacturing to get into distribution and get into?
Why pay the money to Amazon? They're not into distribution.
I mean,
Amazon doesn't do the distribution anyway. So they got wholesalers out there. They can move the orders directly to wholesalers. Amazon works through third-party distributors too, especially global.
Yeah, no, I think it's fascinating. Thanks so much.
Okay.
How do you guys think of portfolio allocation? Not for Steve, but when you say this is a 2-for-1 or 3-for-1?
Oh no, we do it very differently. We think of our portfolio in 2 parts. One part is really just a big, very diversified fund that somebody could have all their money in, which is just a value-oriented. And they're the biggest position. Only get above, I don't think they ever get above 3%. So if you wanted to put all your money in something that was heavily diversified across countries, across industries, with that fairly confident value choice, that's what the diversity fund is. On top of that, we actually look at a certain sub-category of money, which is about 8 to 10% of that portfolio. We will allocate variable. If we put 20% or 8% by the state's position from 2 to 2.6. And that's really the way things work. Because big investments for investors of their age of holdings, you care a lot about this. And you want to know this. If they want to do aspiration, you try and make a lot of money. Oh no, well, remember, there's about 2 times. Think of yourself as having 2 times your investment. Next to one gives you all your money. Okay? Investor 2 gives you 7% of the money. And you're going to put that the same way. And if you're going to give us all your money, what do you want us to do? You want us to, if you're happy if we earn a nice growth, say 3 to 5%. And we just don't want us to lose all of that. We want us to run everything that's going really well. If you're going to give us 7% of the money, what do you want to make sure we do? Right, of course. It's just a different world. So we sort of, and mostly we're